banking reform, and other issues. Thanks.
And I don't know if they've been told, but John Taylor and Lisa Rice, I've been asked to ask you to join me up here for this discussion if you're available and interested. Yeah, up here at the front. Make it a round table. This is supposed to be a round table, not a square or not a classroom. But thanks, Charlie. Again, Ed MIERZWINSKI of the U.S. Public Interest Research Group and John Richard and Ralph Nader thought it might be good to have a couple of housing experts, which I confess not to be, come up here and join me. So I've, without them being planned to be up here, I'm confident that they'll do a fine job. Lisa Rice is Vice President of the National Fair Housing Alliance. Previous to that, she was a founder and CEO of the Toledo and Northern Ohio Development Agency, which is a community development financial institution that works on bringing affordable housing to neighborhoods. And John Taylor, of course, is President and CEO of the National Community Reinvestment Coalition, a leading organization of some 500 groups that works on Community Reinvestment Act protection and other housing issues. Two things we have in common. We each have blood on our foreheads from our terms on the Consumer Advisory Council, banging our heads against the wall at the Federal Reserve Board, trying to get the Federal Reserve to take on more consumer and community work over the years. At least that's the way I remember my term. I don't know if John or Lisa remember their terms the same way. Secondly, all three of our organizations are founding and active members of the Coalition Americans for Financial Reform. All the nation's leading consumer, housing, labor, and civil rights and community groups are members of this group. OurFinancialSecurity.org is the website. We are leading the fight for the community groups and the consumer groups and investor protection groups, as I said, for taxpayers, homeowners, and consumers, another way to look at it, against the phalanx of bank lobbyists who are working against financial reform. The people that caused the system to fail are trying to preserve the system that failed. And believe it or not, they're making headway on Capitol Hill. One of the reasons they're making headway on Capitol Hill is they have some 1,500 lobbyists, according to a study that was done by Bloomberg News, and that's not counting the ones who aren't registered to lobby. That's only the ones who've actually registered, against some 58 consumer lobbyists. At one time, I may be exaggerating just a little bit, I'm convinced that Fannie and Freddie themselves had 1,500 lobbyists. I was at a conference like this 12 years ago. I'll just tell one little story, then I'll ask some questions of my colleagues. I was at a conference that Ralph Nader and the Center put on 12 years ago, 11 years ago. John, when was it, 1998? And Chuck Lewis was the keynote speaker. Chuck Lewis was the founding director of the Center for Public Integrity, publicintegrity.org, a leading investigative reporting organization that studies political power. And Chuck told the story that they had studied every leading power broker in Washington, every influence peddling organization, that from the Chamber of Commerce to others. And he said they all hire former members of Congress. They all hire former staff members from the Hill. But Fannie and Freddie were the only ones that the Center had ever studied that hired the spouses and children of the former staff members and the former members of Congress. That's how much political power they sought to have. In fact, at that conference, Ralph, you might remember, nobody would ask any questions. They were afraid to ask questions. So Ralph was up at the front of the room, and he had to hand out index cards so that people could pass their questions forward. Because if you asked a question in public about Fannie or Freddie, you were put on a list. You got phone calls. Everybody in your office got phone calls. The money to your organization dried up. You're a member of Congress, stopped getting political campaign contributions. It was incredible. You can't describe how much political power they have. And then, like Tom Stanton pointed out, the book, How the Mighty Fall, they fell, but we've got to figure out a way to decide what to do with what's left of them, and I think that's why this is such an important event that we're putting together today. By the way, they fell because of that nexus between political and corporate power. And to those of you who are interested, I understand the Supreme Court did not come out with a decision today in a very important case on opening the floodgates to corporate money in political campaigns. They might still come out with it tomorrow, so keep tuned on that. But in terms of the future of Fannie and Freddie, what to do with Fannie and Freddie, I wanted to pose the question to either John or Lisa, and then we'll open it up to questions or comments from people in the audience. What should President Obama do if you were writing this new report for him? What is the most important thing that your organization thinks he should be saying in that report? Or what is the most important thing that you've learned today that should go into that report? Either one.
Well, if you would allow me, I'd like to back up a little bit. And I think that the various presenters touched on this theme throughout the course of their presentations. But I think one of the first things that need to be discussed is what is the purpose of the FMs? What public purpose do we want them to serve, and do we indeed want them to serve a public purpose? If their public purpose is to buttress the mortgage market and to make housing more affordable and more accessible, then it just sort of seems to me that the FMs cannot be a private entity. So I think one of the first things the report needs to do is sort of back up and look at the whole issue of purpose. What role do we want them to serve? Will they be serving a public purpose? And is it necessary, is it still important for them in this day and age to serve a public purpose?
And I want to, John Taylor, NCRC, I want to emphasize what you were just talking about as well, Ed, and also thank Ed MIERZWINSKI from USPIRG. What USPIRG and Ed does in particular, it cannot be discounted in terms of their contribution. But this whole business of campaign contributions, and more so the lobbying in general from Fannie and Freddie, one of the good things that happened, one of the small good things that happened, I suppose, through this whole mess, is with the collapse and the takeover of the GSEs, the government made it very clear they could no longer do lobbying because the government now owned them. But now that we now know that all these organizations are too big to fail, and in many ways you can really call some of the private Wall Street firms and some of the big banks government-sponsored enterprises. The taxpayers certainly feel that way, and it seems to me that rule ought to be extended to them in terms of the lobbyists. It's ridiculous to be on Capitol Hill and just be tripping over blue-suited lobbyists who are fighting against all the meaningful change to try to make sure that our system does not have the kind of malfeasance and bad practices that really got us into this mess. Whether you want to blame Fannie and Freddie for being the leaders of this, which I think is absolutely absurd, or whether you want to blame Wall Street, or whether you want to blame the big banks, I think they all played a role. But what we need to do is make sure we create a system that doesn't allow that to happen in the future. I think there's an important role for the GSEs. I think it's important for us not to throw the baby out with the bathwater, but to make sure that in whatever form they take, and I'd like to think that continuing to be a government-sponsored enterprise that could make enough profit so that it could do more of its mission, its original mission, and that is to help people into the mortgage market who otherwise may not be able to be in it, would be a good thing. But there has to be safety and soundness and other types of oversight that ensures that that happens. What's very ironic is, and some of you may have guessed, working for an organization like the National Community Reinvestment Coalition, someone would probably attach a label to me of being a liberal. And that's okay, it will stick on me, and I'm very proud of it. But what's ironic about that is the amount of times I was invited into Congress to hearings and to meetings to speak, invited by Republicans and conservatives, because of my views relative to Fannie and Freddie, feeling that they weren't doing enough with this government-sponsored benefit they had, and this too big to fail benefit. And so I would argue for stronger housing goals and for them to go deeper into minority neighborhoods and so on because of the benefit and the privilege that they occupy. And I would find myself fighting with Democrats over this who thought I was critical of Fannie and Freddie, but that's what I was critical of them for. I wasn't critical for what their core mission and what they were doing. And, you know, and here's the rub. 10 years ago, the American mortgage system was the envy of the world. And now it's, what, the Danish system? That's pretty rough. But there was a time when our mortgage system worked very well. There was a time when we had regulatory oversight. There was a time that the GSEs worked very well. But unfortunately, we allowed industry, both private sector and government sponsored, to evolve into areas without any oversight, without any safeguards, without anybody reining them in, to the point where it brought all of us down. And I think we can correct that without throwing the baby out with the bathwater.
And can I add one more comment? John, I'm glad to hear that you are proudly wearing the red letter L. I do too, I guess.
That means something else.
But I think that also any report needs to look at, because we have talked about the fact that the FMs have a mission, but any report needs to look at how well the FMs fulfilled their mission. Did they actually do a good job? And here's, John, where I'm going to differ with you a little bit. I don't think that they did, particularly in underserved markets. I don't think that the FMs did a very good job of fulfilling their mission when it comes to underserved markets. And that really needs to be looked at and analyzed. From where I sit, and based on the work that I have done in the field, working, of course, primarily in the states of Ohio and Michigan, the underserved markets sort of served as an incubator for the subprime market to, if you will, in the home mortgage industry, to sort of hone and perfect some of the practices that it used and then extrapolated to the larger market. And I think that if the FMs had done a better job of penetrating those underserved markets, that some of that could have been staved off.
You actually don't disagree, because that's exactly the position we took, is that they weren't doing enough. So we're on the same page on that.
Just to clarify for the C-SPAN audience, you're talking about they didn't do enough to do what? Police the loans, police the practices, or just make more loans in those markets?
They didn't purchase enough loans from low and moderate income communities and communities of color that would have enhanced the ability for those populations to get really good quality, safe and sound loans. They lived and dwelled in the realm of middle and upper income lending and kept raising the mortgage limit to the point where, I mean, an affordable a mortgage that they need to securitize at over $700,000. I mean, and that was supported by people like Bonnie Frank and others. It just to me doesn't strike me as what we really needed a government-sponsored enterprise's help in this mortgage market to do, is to help people get $700,000 mortgages. I could be wrong.
I also think that what we heard a lot of when we would approach the FMs about their lack of penetration in underserved markets was, well, it's not our fault. If the lenders that we do business with are not selling loans in these communities, then we cannot purchase them. And if the lenders that we're doing business with don't sell loans in these communities based on our underwriting guidelines and utilizing our products, the products that we develop, then we can't purchase loans in those communities. One of the biggest barriers was that Fannie used an automated, and Freddie used an automated underwriting system, and prior to that, their underwriting guidelines were very prescriptive and very rigid, but they also included barriers to fair lending. And so when we would push for them to do things like consider non-traditional credit, we were sometimes met with a huge bureaucracy of just trying to matriculate through that huge bureaucracy to get new products and new underwriting guidelines developed that would warrant more lending in underserved markets. But I have to say that when we were able to get there and to develop pilot programs that could be used in underserved markets, they worked very, very well. Yes. So when we finally were able to get the programs and the products that we needed, they worked well. The problem was that the curve of developing those programs and products and then bringing them to market in a real way was very, very substantial. I mean, it was a very, very long lag time.
Why did Fannie and Freddie seek to increase the size of the loans that they could make, and why didn't they promote manual underwriting so that you could help more lower income and people of color get loans?
Profit?
Profit? Okay.
I think, Lisa, though, in the last comment raised a point that wasn't raised in the earlier discussions, and I want to make sure that that's driven home. What Fannie and Freddie said to us a lot of times is, look, the banks are not bringing us the prime and good product loans in low and moderate income neighborhoods and communities of color. What we're seeing is what the subprime and the market has shifted into that direction. I do think this is a great part of the unexplained, undiscussed aspect of what occurred in this crisis. The banks really abandoned a lot of these LMI areas and low and moderate income areas, and don't assume that a home ownership or the ability of someone to pay on a mortgage is necessarily a higher risk in a low-income neighborhood than it is in a middle and upper-income neighborhood. In fact, Fair Isaacs and Company, FICO scores, Fair Isaacs and Company, maintains that income is negatively correlated in the home mortgage market performance, in the home mortgage performance, meaning income in and of itself is a factor. The lower the income, the more likely that it can be paid off. And that's because if a low-income person loses their job, they can find another income through all sorts of means that could meet that mortgage. Not so for middle and upper income. It's more complex. There's more money involved. There are other factors that are in that black box and those credit scoring models that Lisa referred to a few minutes ago. But when the private sector, the banks, the mainstream banks, pulled out of these neighborhoods and closed their branches, what moved in was the subprime and often predatory lenders as the service of choice. And also, the basic banking services became payday lenders, pawn shops, and check cashers. So in the working poor neighborhoods of America, we shifted our financial services sector with this, someone referred earlier to the shadow financial services sector. There's a real shadowy aspect to some of the shadow financial services sector that really preyed upon people, that really put people in positions that they shouldn't have been in and approved them for loans with terms and conditions that, you know, any reasonable person wouldn't have done.
And we can broaden that too to not just LMI markets, but
Yes.
Underserved markets too. Let's take a look at Prince George's County, the highest income county in the United States in terms of African American wealth. Over 50% of mortgage loans in Prince George's County were subprime mortgages. And from my work in the field, I started out as a fair lending advocate. I ran the Toledo Fair Housing Center. When I was there, we filed more fair lending lawsuits than any other fair housing or civil rights agency in the country. And what we would see over and over and over again were lenders who were not willing to go into underserved markets, even if we were talking about more affluent African American and or Latino markets with their prime sort of plain vanilla products. In fact, I can remember going through, we used to be able to purchase AmeriState or PACE data in Ohio, which it's similar to CoreLogic data, and we could look at every single address. It would provide the interest rate and who the financier was for that particular mortgage. I'd sit down with mainstream lenders and I'd say, look, this person has a loan at ITT, this person has a loan at Beneficial, 18%, 25%. Go to that person and refinance them. There's your mortgage. They refuse to do it. But surprisingly, they would, when they adopted subprime lending divisions, what we found was the same lenders whose prime entities would not go into these neighborhoods and make prime loans somehow were able to penetrate these communities with subprime loans and with their subprime entities. What we also found, and we were able to document this through a program that we developed with Fannie Mae, it was an anti-predatory lending remediation program where we would take folks who had subprime loans, if we determined that they were predatory, refinance them into a prime loan, and the #1 criteria for participation in that program was, at the time that you got the subprime loan, you qualified for a prime loan. And we had consumer after consumer after consumer who actually qualified for a prime loan, and they got a loan with a subprime entity. Many of those subprime entities were actually subsidiaries of holding companies that also had a prime lender who was operating in the larger geographic area. So what we have seen is, as John has said, prime entities and sort of mainstream lenders not willing to go in with their less risky products or their less risky underwriting models into underserved neighborhoods to generate and originate mortgages, but they would go in with the higher cost products in order to generate mortgages in those areas.
Great. We have some time to take some questions or comments from the audience for the panelists. Are there any questions, comments?
Ed, while we're waiting for the question, I do want to say, too, something that Lisa referenced, and that is that we have this forum on home ownership and mortgage lending. The truth of the matter is the crisis we're in had very little to do with home ownership. Most of the loans that we're talking about were really refinance loans. I've seen statistics that say less than 10% of the mortgages that were made or the loans that were made resulted in somebody actually getting a home. It was somebody getting a bigger home, it was somebody refinancing, it was somebody taking money out. But it was really the industry doing this Las Vegas-style gambling with lending as a way of making a lot of profits, not a way of creating increased home ownership. So a lot of the great ideas from Denmark and elsewhere sound great, but you know, you're really talking about getting people into home ownership. What we're talking about is really a malfeasant, unregulated lending industry that was allowed to get away with murder. And hopefully we're going to have a Congress that has I have to think of a nice word to do this, but has the fortitude to really change the system so we return to ethics and a rule of law in our system of regulating financial services sector.
Great. Ralph, you had a question?
As I said, I think it was 1988 or 1978, we worked to get the National Cooperative Bank law passed. And that bank now has most of its portfolio in housing, not so much consumer co-ops. What's your view? The promise of that bank, the failure of that bank, and the model of that bank to provide loans for apartment housing, but also to have a low-income development unit in the bank for low-income people.
I'm not familiar with the model that you're talking about. I'm not familiar with that portfolio. But let me say this. I don't necessarily think that we have to come up with new models to service adequately underserved communities. I don't think we have to do that. I think we have enough robust data. You could just take the data, for example, from the CDFI sector, who focuses on lending to underserved markets, and you can really call that data. You can analyze that data and help use that data to buttress sort of our mainstream systems, if you will. So I don't know that we have to, keep coming up with new systems or new models or what have you. I think what we need to be doing is focusing on ways to move folks who are currently underrepresented or who are from underserved markets, moving them into the mainstream market. I do think also that there are more protections in the mainstream market. It's certainly what we have seen as a result of the financial crisis today.
Lisa, this is not a new model.
Yeah. Okay.
The co-op model, vector toward low-income people, is an old model.
Okay.
The point is that the National Cooperative Bank, which was supposedly a bank to liberate funds for low-income as well as middle-income co-op housing, has not gotten the attention of your communities. What they say over the years is they're not getting enough demand for their loans.
Right. So my comment would be that they've been a non-factor, Ralph.
Yeah.
But although you look in Canada and you see the cooperative banks there, and you're seeing a tremendous amount of activity that working class people really rely upon them. But I'll take a cooperative structure we have here in the United States, the credit unions. Okay, that's a cooperative structure. It's got members and that sort of thing. Well, you know, the problem with that, and again, it has to do with the application of law and the regulatory oversight. You look in communities of color and low-income communities, you know, the credit unions will say, oh, we didn't do very much of that malfeasant lending. Well, they didn't do much of lending in LMI and minority areas to begin with. They disproportionately lag banks in serving working class people, which seems kind of crazy for an institution that was created on the basis of serving people of modest means. And what are they doing now? I don't know if people realize this. They're on Capitol Hill right now pushing to create a line of credit available to the credit union industry. So forget the cooperative membership model. They're now trying to, you know, put themselves in the position of actually having, I don't know whether it's access to the Fed window or where they're expecting this line of credit, clearly from the taxpayers, right? A line of credit that they can now use to compete further with the banks without having an obligation like banks to serve safely and soundly low-income communities, and not even paying corporate taxes. I mean, that's an extra benefit that credit unions get. So I went off on a tangent, but I think it's more relevant to the point you're making, Ralph.
Are there, we have time for about one more question, if there are any more questions from the audience or comments on the event today. And then, Charlie, are you or Ralph having any closing comments from Ralph Nader? Well, I want to thank everybody, and I want to thank my last-minute panelists here for their participation. Again, the coalition that is working on a variety of reforms, not specifically Fannie and Freddie, but against the entire financial industry to preserve and reform the financial system, is Americans for Financial Reform, ourfinancialsecurity.org. My website is usperg.org. Lisa's is fairhousing.org?
Nationalfairhousing.org.
Nationalfairhousing.org. And John's is NCRC, National Community Reinvestment Coalition, ncrc.org. Thank you.
And while Ralph is coming up, let me just also comment. I think all of us advocated with then OFEO to not allow the FMs to use their purchases of subprime mortgage-backed securities to meet their affordable housing goals, and OFEO chose not to listen to us, and HUD chose not to listen to us. So I think that has to be another component of any assessment of the GSEs. When sort of folks working on the ground give, you know, advocate for different positions with the various regulators, how those various positions are considered by the regulators.
Thank you. That's an important point. Thank you.